Year 12's, the purpose of this video is to summarise for you the different types of businesses and their features. This is not intended to replace the more detailed information that you've been given in class and the more detailed notes that you will have taken on that information. Instead, I suggest that you use this video to consolidate the knowledge that you already should have about the types of businesses and their features. There are 6 types of businesses that you need to be familiar with. These are firstly, sole traders, secondly, partnerships, thirdly, private limited companies, fourthly, public companies, and fifthly, social enterprises. All of these types of businesses are found in the private sector. The private sector is that part of the economy that is operated by private individuals, private groups, or private institutions. So all of these businesses are owned by private individuals, private groups, or private institutions. The 6th type of business is the government business enterprise, or GBE. This type of business is found in the public sector. The public sector is that part of the economy that is operated by the government. So government business enterprises are businesses that are owned by the government. Now it's important that you don't confuse the fact that public companies are called public companies with the fact that public companies are found in the private sector. This is because public companies are not owned by the government. Instead, public companies are owned by private individuals, private groups, and private institutions. We can describe sole traders, partnerships, and companies by reference to their features. For these purposes, there are 9 features that we can look at. Firstly, the treatment of profits and losses. Secondly, liability for business debts. Thirdly, control over business decisions. Fourthly, key man risk. Fifthly, perpetuity. Sixthly, establishment costs. Seventhly, government regulation. Eighthly, their ability to raise finance. And ninthly, tax. The first type of business that you need to be familiar with is a sole trader business. A sole trader is a person who owns a business by themselves and operates that business under either their own name or a registered business name. The important word in this definition is owns. If you're ever asked to define a sole trader, make sure that you use the word owns in your definition. Let's now look at the features of a sole trader. Because the sole trader is the only owner of the business, they are entitled to all of the profits of the business. However, just as a sole trader is entitled to all of the profits of their business, the sole trader also bears all of the losses of the business. Another way of putting that is to say that a sole trader has unlimited liability. This means that the sole trader is liable to pay all of the debts of their business. If the business can't pay its debts, then the sole trader's personal assets, such as their car, their house, may need to be sold to pay those debts. Because the sole trader is the only owner of the business, the sole trader has total control over all business decisions, and the sole trader is able to make all decisions about the business. There are no other owners who need to agree to any of those decisions. However, because the sole trader is the only owner of the business is exposed to key man risk. This means that the success of the business relies on the sole trader's knowledge and skills. Put another way, if the sole trader is hit by a bus, then the business will no longer operate because it ceases to have an owner. A more technical way of describing this is to say that a sole trader business has no perpetuity. That is, the business ends when the sole trader retires. Now, the sole trader might retire simply because they don't want to operate the business any longer. Alternatively, they might be permanently retired if they die. Note, however, that just because a sole trader business has only one owner doesn't mean that only the owner works in the business. On the contrary, a sole trader can employ other people to work in the business with them. It is just that these other people are not owners of the business. An advantage of a sole trader business is that it is very simple and inexpensive to establish that business. The main thing that a sole trader has to do is to register a business name for the business. On the other hand, one disadvantage of a sole trader business is that it is more difficult for a sole trader to raise finance, that is, to borrow money from the bank. This is because the assets that are used in the business and the sole trader's personal assets, such as their house and their car, are both owned by the sole trader. This makes it difficult for a bank to take security for a loan to the sole trader because the sole trader won't want the bank to take security over the sole trader's personal assets. The sole trader will only want the bank to take security over the assets that are used in the business. This in turn means that the bank will need to specifically identify the assets that are used in the sole trader business and will need to take security just over those assets. Unlike companies, there is relatively little government regulation that applies to a sole trader business. The main requirement is that the sole trader must keep financial records. Finally, a sole trader pays tax on the profits made by the sole trader business at the sole trader's personal tax rate. What this means is that at higher levels of profit, that is, when the business is being very successful and generating more profit, the sole trader may pay more tax than a company. This is explained in more detail on the next slide. The blue line shows the personal income tax rate that applies to a sole trader. Where a sole trader business makes a profit, the sole trader must pay tax on that profit at the sole trader's personal income tax rate. You can see that the personal income tax rate increases as the profit of the sole trader's business increases. If the business makes a small profit of less than $18,200 in a year, then the sole trader doesn't pay any tax on that profit. However, if the sole trader business makes a profit of between $18,200 and $37,000 in a year, then the sole trader must pay tax on each dollar of profit above $18,200 at the personal income tax rate of 19%. For example, if the business makes a profit of $18,201, then the sole trader must pay tax on that extra dollar. This tax is calculated at the rate of 19% and amounts to 19 cents. You can see that as the profit of the sole trader business increases, the sole trader pays an increasing amount of tax. If the sole trader business makes a profit above $180,000 in a year, then each dollar of profit over $180,000 is taxed at the highest tax rate of 45%. Now, compare this with the tax that a company pays. The green line shows the corporate income tax rate that applies to companies. Where a company makes a profit, the company pays a flat tax rate of 27.5% if it is a smaller company and 30% if it is a larger company. But unlike a sole trader, a company pays tax on each dollar of profit that it makes. When a company's profit is small, then the company will be paying more tax than a sole trader would pay on the same profit. For instance, if the company's profit is less than $18,200 in a year, then the company still pays 27.5% of its profit as tax, whereas a sole trader would pay no tax on that profit. However, as a company's profits increase, there comes a point at which the company pays less tax than a sole trader pays on the same amount of profit. This is because a company pays tax at a fixed percentage. That does not change with the profit that the company makes, whereas a sole trader pays tax at a percentage that increases as the profit increases. Under the current tax regime, a sole trader pays less tax than a company up to a profit of $131,610. But a sole trader pays more tax than a company on profits that are greater than $131,610. So you can see that a disadvantage of being a sole trader is that a sole trader pays more tax than a company where the profit is large. Conversely, a disadvantage of being a company is that a company pays more tax than a sole trader where the profit is small. This brings us to the second type of business, which is a partnership. A partnership consists of two or more people, called partners, who own and carry on a business together. In this definition, the important word is own. If you're ever asked to define a partnership, make sure that you include the word own in your definition. Let's now look at the features of a partnership. The first feature is that in a partnership, the partners share any losses of the business between themselves. Like a sole trader, a partnership has unlimited liability, which means that the partners are liable to pay the debts of the business. Put another way, if the partnership business cannot pay its debts, then the partners' personal assets, such as their houses and cars, may need to be sold to pay those debts. However, the advantage that a partnership has over a sole trader is that because any losses of the business are shared between more than one person, there's perhaps less likelihood that a partner is going to have to sell as many of their personal assets to pay the debts of the business as they would have to do if the business was a sole trader business. Now, just as the partners in a partnership share any losses of the business between themselves, so they must also share any profits of the business between themselves. Another advantage of a partnership is that key man risk is reduced. This is because there's now more than one owner of the business who can share in the workload of the business. It's also because the different partners may contribute different skills to the business. One partner may be particularly skilled in the technical aspects of producing the product that the business produces. Another partner may be an expert in sales and marketing, and so is able to develop a sales and marketing campaign to sell the product that the business produces. Another partner might be an accountant, and so can do the accounting for the business. In short, unlike with a sole trader, a partnership business is not largely dependent upon one person bearing the workload of the business and upon the skills of that one person. Now, like a sole trader, a partnership can also employ other people to help in the business. The difference is that these employees are not owners of the business. A disadvantage of a partnership, though, is that because each of the partners is an owner of the business, they will need to agree on decisions about the business. This means that there is potential for disputes between the partners, and if the partners have too many disputes, then this could adversely affect the business because the partners are too busy disagreeing amongst themselves rather than running the business. Like sole traders, partnerships are simple and inexpensive to establish. The main thing that a partnership needs to have is a partnership agreement, which sets out the terms on which the partners have agreed to own and carry on a business together. Like a sole trader, a partnership has no perpetuity. If all of the partners retire, then the business comes to an end. Like a sole trader, minimal government regulation applies to partnerships. It is true that Partnerships must keep financial records for the business, but there are a few other regulations that apply to them apart from that. Like a sole trader, partners have to pay tax on the profits that are paid to them from the partnership at their personal tax rate. And this means that where a partnership is making high levels of profit, then the partners may end up paying more tax than if the business was structured as a company. I've already explained the reasons for this when we looked at the slide that set out personal income tax rates compared to company income tax rates. You might want to refresh your memory by going back over that slide. The third type of business is a company. A company is an incorporated body that is a separate legal entity from its owners, that is, its shareholders. If ever you're asked to define a company, make sure that you include the words incorporated and separate legal entity in that definition. To be incorporated, that is, brought into existence, a company has to be registered with a government agency called the Australian Securities and Investments Commission, or ASIC, A-S-I-C for short. It is very easy to incorporate a company. The shareholders sign the constitution of the company, that is, the rules about how the company is to operate. The shareholders appoint the directors of the company, that is, the people who are responsible for managing the company. And the shareholders agree to buy shares in the company. Once this has been done, the shareholders and the directors must lodge certain forms with ASIC. And ASIC then includes the company in its register of companies. It is at that point that the company comes into existence. That is, it's at that point that the company is incorporated. Now, a company is very different from a sole trader and a partnership. As we've already seen, a sole trader is a person who owns a business. That is, a sole trader owns the assets of the business. For example, a sole trader who owns a milk bar business owns the shop, the refrigerators and counters, and the milk, bread and ice creams, etc. that the milk bar sells. These are the assets of the business. Similarly, in a partnership, the partners own the assets of the business. For example, in a partnership of lawyers, the partners own the computers, desks and chairs that the lawyers use. However, in the case of a company, the owners, that is the shareholders, own shares in the company. And the company owns the assets of the business. The shareholders do not own the assets of the business. They own the company because they hold shares in the company. In addition, a company's business is not managed by the shareholders. Instead, it is managed by a board of directors, which is appointed by the shareholders, and by a management team that is headed by a chief executive officer and is appointed by the board of directors. So you can see that a company is very different from a sole trader and a partnership. First, the business is not owned by the shareholders, but by a separate entity called a company. Second, the business is not operated by the shareholders, but by the directors and the management team of the company. As you can see from this diagram, the company is a thing, that is a body, that exists separately from the shareholders. It is for this reason that we say a company is a separate legal entity. Because a company is a separate legal entity, like a person, it can do all the things that a person can do. In particular, the company can enter into contracts for the business, the company owns the assets used in the business, the company employs the people who work in the business, and the company can borrow money from a bank for use in the business. Because a company has a separate existence from its owners, that is, its shareholders, the company does all of these things in its own name and not in the name of its shareholders. So, for example, if the company cannot repay money that it has borrowed from a bank, then the bank sues the company and not the company's shareholders. You might ask, why do people want to buy shares in a company? To understand this, we need to consider the ways in which a company can obtain the money that it needs to operate its business. Obviously, one way a company can obtain this money is by producing and selling goods or services. However, what happens if the revenue that the company earns from selling goods or services is not enough to cover all of the expenses of the business? For example, the company might need to buy premises or equipment for the business. In such a case, the company could borrow money from a bank. Of course, the bank doesn't just give this money to the company for free. Instead, the bank charges the company interest on the loan. So, if the bank loans the company $100 at 10% interest per annum, that is per year, then not only does the company have to pay the $100 back to the bank, but until it does that, the company has to pay $10 per year in interest to the bank. That is 10% of $100. Well, instead of borrowing money from the bank, the company could sell shares in itself to people who want to become shareholders, that is, owners of the company. So, for example, the company could sell 100 shares in itself for $1 per share. It might sell 25 shares to shareholder 1, who pays the company a total of $25 for those shares. And it might sell the remaining 75 shares to shareholder 2, who pays the company a total of $75 for those shares. This adds up to $100 being paid to the company. This then brings us back to the question of why do people want to buy shares in a company? Well, let's assume that in 1 year the company makes a profit of $12. When a company makes a profit, it pays some or all of that profit to its shareholders. This payment is called a dividend, D-I-V-I-D-E-N-D. Now let's further assume that the company decides to pay all of this $12 profit to its shareholders. That profit will be paid to and divided amongst the shareholders, that is shareholders 1 and shareholders 2, in proportion to the number of shares that each shareholder owns. If we take shareholder 1 owns 25 shares, which is 1/4 of the shares in the company, that is 25 out of 100 shares. Accordingly, shareholder 1 will be paid a dividend of 1/4 of the $12 profit, which is $3. Looking now at shareholder 2 owns 75 shares, which is 3/4 of the shares in the company. That is 75 out of 100 shares. Accordingly, shareholder 2 will be paid a dividend of 3/4 of the $12 profit, which is $9. So, one reason why a person will buy shares in a company is to be paid dividends. Just like the interest that a bank earns is payment for the bank lending money to the company, so a dividend is the return that a shareholder earns for giving money to the company by buying shares in the company. Shareholder 1 has given the company $25 for 25 shares, and the dividends that are paid to shareholder 1 are the return that shareholder 1 gets for paying this money to the company. Shareholder 2 has given the company $75 for 75 shares, and the dividends that are paid to shareholder 2 are the return that shareholder 2 gets for paying this money to the company. There are two main differences between the company getting money from a bank by borrowing that money and the company getting money from its shareholders by selling shares in itself to those shareholders. The first difference is that a company has to pay interest on a bank loan whether or not it makes a profit. However, A company can only pay a dividend to its shareholders if it makes a profit. If the company makes a loss, it cannot pay a dividend to its shareholders because a dividend is a payment of the company's profit to shareholders. The second difference is that the interest that a company pays to a bank is set at a particular rate, for example 10% per annum. That is, a company must pay to the bank each year 10% on the amount that the company has borrowed. However, because the profit that a company makes changes every year, the amount that a company pays to its shareholders by way of dividend will also change from year to year. If a company makes a large profit, the shareholders will be paid a large dividend. If a company makes a small profit, then the shareholders will be paid a small dividend. Provided a company makes a profit, a shareholder will be paid a dividend for as long as the shareholder owns shares in the company. Another reason why a person may want to buy shares in a company is because shares are valuable property that the shareholder can sell. Shares are valuable because they entitle a shareholder to receive a dividend every year. Now let's suppose that shareholder 2 sells 25 of its 75 shares to George, and that George pays shareholder 2 $2 for each of those 25 shares. That is a total of $50. Shareholder 2 has made a profit called a capital gain by selling those shares to George because it bought those shares for $1 each from the company, but it sold those shares to George for $2 each. So a second reason why a person will want to buy shares in a company is that at some time in the future they can sell those shares and make a profit. Note, however, that the value of a share can change over time with changes in the economy and with changes in how well the company's business is doing. So there is actually no guarantee that a shareholder will always make a profit if they sell their shares in a company. Well, after shareholder 2 has sold 25 shares to George, George now becomes a shareholder in the company along with shareholder 1 and shareholder 2. And so George will now be entitled to receive dividends when the company makes a profit, and if he wants to at some time in the future, he will also be entitled to sell some or all of his 25 shares in the company to another person who will then also become a shareholder in the company. Now you might ask, what does a share look like? The answer is that you can't see a share, but when a person such as shareholder 2 buys shares in a company, the company gives that person a share certificate. A share certificate is a piece of paper that says how many shares a person owns in a company. If we take the case of shareholder 2, when shareholder 2 bought 75 shares in the company, at that time the company will have given shareholder 2 a share certificate that records shareholder 2 as being the registered holder, that is the owner, of 75 shares in the company, which for these purposes we've called VUSC Limited. When a shareholder, such as shareholder 2, sells some of its shares to another person, such as George, then the company will replace shareholder 2's share certificate. This is because shareholder 2 no longer owns 75 shares. Instead, shareholder 2 has sold 25 of its shares to George, and so shareholder 2 now owns only 50 shares in the company. So the company will replace shareholder 2's share certificate for 75 shares with a share certificate that records shareholder 2 as owning 50 shares. At the same time, it will give George a share certificate which records him as being the owner of 25 shares in the company. These are the 25 shares that George bought from shareholder 2. By holding shares in the company, That is, by becoming a shareholder, George becomes an owner of the company. In this case, he owns 25% of the company because he owns 25 of the 100 shares. In other words, a shareholder is a person who owns shares in a company and is therefore an owner of the company. There are two kinds of companies that you need to be familiar with. These are private limited companies and public companies. A private limited company is a company that has no more than 50 non-employee shareholders and that has Pty Ltd, which stands for Proprietary Limited, at the end of its name. This type of company is commonly used for smaller businesses. When we refer to non-employee shareholders, we mean shareholders in a company that are not also employees of the company. On the other hand, a public company is a company whose shares are listed, that is traded, on the stock exchange and that has Ltd, which stands for limited, at the end of its name. This type of company is commonly used for larger businesses. There are two very important differences between private limited companies and public companies. The first difference relates to the circumstances in which a shareholder can sell shares in the company. A shareholder who owns shares in a private limited company can only sell those shares to another person with the permission of the other shareholders. That is, a shareholder who owns shares in a private limited company can only sell those shares to another person if the other shareholders in that company agree to the shareholder selling their shares to that other person. Let's take the example of Zoe Proprietary Limited, which, because it has Pty Ltd at the end of its name, is a private limited company. You can see that there are three shareholders in Zoe Proprietary Limited. These are S1, who holds 10 shares, S2, who holds 20 shares, and S3, who holds 10 shares. Let's suppose that S1 wants to sell 6 of its 10 shares to Dylan. Because Zoe Proprietary Limited is a private limited company, S1 can only sell those 6 shares to Dylan if S2 and S3 consent, that is, agree to that sale. It's only if S2 and S3 agree to that sale that Dylan can become a shareholder in Zoe Proprietary Limited by buying 6 shares from S1. We can contrast this with the example of Hannah Limited, which, because it only has Ltd at the end of its name, is a public company. Again, we have 3 shareholders in Hannah Limited, S1 who holds 10 shares, S2 who holds 20 shares, and S3 who holds 10 shares. Unlike a private limited company, the shares of a public company are listed on the stock exchange. This means that shares in that company are bought and sold on the stock exchange. The stock exchange is effectively a market on which people buy and sell shares in public companies. Shareholders who want to sell shares in a public company notify the stock exchange of the number of shares they want to sell and the price they want to sell those shares for. Similarly, people who want to buy shares in a public company notify the stock exchange of the number of shares they want to buy and the price they are prepared to pay for those shares. The operator of the stock exchange then matches sellers and buyers. However, the sellers don't know who they are selling their shares to, and the buyers don't know who they are buying their shares from. Instead, a buyer who is matched with a seller pays the purchase price for the shares to the stock exchange, and the stock exchange then pays that money to the seller. So, for example, if S1 wants to sell 6 of its 10 shares in Hannah Limited, it notifies the stock exchange that it wants to sell 6 shares in Hannah Limited at, say, $2 each. If Dylan wants to buy 6 shares in Hannah Limited, then he notifies the stock exchange that he wants to buy 6 shares at, say, a price of up to $2 per share. In such a case, because there is a match between the number and price of the shares in Hannah Limited that S1 wants to sell and the number and price of the shares in Hannah Limited that Dylan wants to buy, Dylan will buy S1's 6 shares. Dylan buys those 6 shares by paying $12 to the stock exchange, that is, 6 shares at $2 each. The stock exchange then pays that $12 to S1. In this way, Dylan becomes a shareholder in Hannah Limited, along with S1, S2 and S3, that is, the existing shareholders in Hannah Limited. The second difference between a private limited company and a public company relates to how the company can sell shares in itself to shareholders. A private limited company is not allowed to offer to sell shares in itself to the public. That is, it's not allowed to advertise its shares for sale to the public. Instead, if a private limited company wants to obtain money by selling shares in itself, it must individually approach people who it thinks may want to buy those shares and ask each of these people if they do in fact want to buy shares in the company. As a result, it's not easy for a private limited company to raise money from shareholders because it cannot advertise its shares as being for sale. On the other hand, a public company is allowed to offer to sell shares in itself to the public. It does this by publishing a document called a prospectus, which provides information about the company and which invites anyone who wants to buy shares in the company from the company. As a result, it's much easier for a public company to raise money from shareholders because it can advertise its shares as being for sale. Because a public company is able to advertise its shares for sale, a public company is able to reach out to a very large number of people who may be interested in buying shares in the company. This is the reason that many public companies have thousands of shareholders. Let's now look at the features of a company. First, because a company is a separate legal entity from its shareholders, the company, and not the shareholders of the company, are responsible for the debts of the business. This means that the shareholders of a company have limited liability. That is, unlike a sole trader or a partnership, the shareholders are not liable to pay the debts of the business, and so the shareholders' personal assets are not at risk of being sold if the business cannot pay its debts. If the business can't pay its debts and the business fails, then the shareholders' shares in the company won't be worth anything, and so the shareholders will have suffered a financial loss. But the important thing is that the people who the business owes money to cannot have the shareholders' personal assets sold to repay the debts that the business owes to them. Second, where a company owns a business, key man risk is reduced because the company can employ employees with a mix of skills. This means that if any of those employees leaves or dies, the business is unlikely to fail because the business is not dependent on the skills of just one person or on the skills of a small group of people. On the other hand, in a company, decisions about the business are generally made by the board of directors and the management team. The shareholders have little control over these decisions because while they own the company owns the business, and the shareholders are typically not involved in running the business. Instead, the business is run by the board of directors and the management team. Unlike a sole trader and a partnership, a company has perpetuity. This means that it continues in existence despite any changes in its shareholders. That is, even though a shareholder sells its shares in the company will continue in existence and will continue to own and operate the business. This is because the company is a separate legal entity from its shareholders. However, a company is more expensive to establish than a sole trader or a partnership. This is because a company is established as a separate legal entity by being registered by ASIC. ASIC charges a fee for registering a company, and it also requires a company to pay an annual fee to it. Next, because a company is a separate legal entity from its shareholders, it is liable to pay tax on the profits of the business at the corporate income tax rate, which is currently 27.5% for smaller companies and 30% for larger companies. As I've explained in the context of the slide that compares personal income tax rates with corporate income tax rates, a company will pay less tax on higher profits than a sole trader or a partnership. On the other hand, a company will pay more tax on lower profits than a sole trader or a partnership. Because a company is a separate legal entity from its shareholders, it must comply with a range of government regulations that regulate companies. For example, it must prepare annual financial statements such as the income statement and balance sheet, and it may be required to have those financial statements audited by an auditor. A company must also lodge an annual tax return with the Australian Taxation Office. It can cost quite a lot of money for a company to comply with all of these obligations. Finally, it's easier for a company to raise finance, that is, to borrow money from a bank, than it is for a sole trader or a partnership to borrow money from a bank. This is because it is easier for a bank to take security for a loan to a company. Because the company owns all of the assets of the business, the bank just takes security over all of the assets of the company. This means that if the company is unable to repay the loan, the bank can sell the company's assets and use the money from that sale to pay off the company's loan. Comparing the features of a company with those of a sole trader and a partnership, it's likely that you will come to the view that, in most cases, it is better to use a company rather than a sole trader or a partnership to own and operate a business. The final two types of businesses that we need to look at are social enterprises and government business enterprises. A social enterprise is a private sector business that produces goods or services to sell, but distributes any profit it makes to achieve social or environmental goals rather than to its shareholders. If ever you're asked to define a social enterprise, make sure you include in that definition the concept that a social enterprise distributes any profit it makes to achieve social or environmental goals. A social enterprise is often structured as a company. That is, it has shareholders who own the company and a board of directors and management team who run the company. Like any other company, a social enterprise has the objective of making a profit by selling goods and services. Don't make the common mistake of saying that a social enterprise is not interested in making a profit. A social enterprise is most certainly interested in making a profit, but unlike an ordinary company, it does not distribute that profit to its shareholders. That is, it doesn't pay dividends to its shareholders. Instead, a social enterprise uses its profits to pay for social or environmental goals. For example, a social enterprise might have a social goal of training unemployed youths. There are, in fact, a number of cafes around Melbourne that train unemployed young people to work in the hospitality industry, that is, in cafes, restaurants and fast food outlets. These cafes have the objective of making a profit by selling food and drink to customers. But they use this profit to pay for staff who train unemployed people to serve at the cafe as counter staff, baristas, cooks, and dishwashers. Other social goals that a social enterprise might have include employing refugees and providing food for the homeless. An example of an environmental goal is supporting local food producers. For instance, a social enterprise might only sell fruit and vegetables that are grown by local farmers rather than fruit and vegetables that are imported from overseas. This is an environmental goal because buying fruit and vegetables from overseas means that fuel is used in aeroplanes and ships to transport that fruit and vegetables to Australia, and burning this fuel pollutes the environment. In such a case, the social enterprise wants to make a profit from selling locally produced fruit and vegetables, but it might then use this profit to fund research into supporting the use of sustainable farming practices by the local food producers. For example, it might fund research into the use of organic rather than chemical fertilisers, the idea being that organic fertilisers, unlike chemical fertilisers, don't damage the soil and pollute rivers. Lastly, we come to government business enterprises. A government business enterprise, or GBE, is a business that is owned and operated by the government. That is, it operates in the public sector. If ever you're asked to define a government business enterprise, make sure that you include in your definition the point that a government business enterprise is owned and operated by the government. A GBE, or government business enterprise, is structured as a company. That is, it has shareholders, usually government ministers, and a board of directors, which is appointed by the government. Like any other company, a government business enterprise has the objective of making a profit by selling goods and services. Indeed, a government business enterprise often provides essential community services such as transport, health, housing, and postal services. Just think of Australia Post, which is the government business enterprise owned by the Commonwealth Government that is responsible for delivering our mail. However, unlike an ordinary company in the private sector, the government will often require a government business enterprise to comply with certain community service obligations. A community service obligation is an obligation to provide some kind of benefit to the community. For example, the government might require a government business enterprise to provide its services at a discount to elderly, sick, or rural people. Well, that brings us to the end of this video. I hope that you have found it useful. Thank you.